Good morning. This is Jason, certified financial planner with Advise Edge and host of the Fighting Words Financial Podcast. I am not appearing on video today because I am not feeling well and I probably look like I feel like crud. So I did want to go ahead and fulfill my promise of making at least 3 videos a week. And I want to make 3 videos a week for an entire year. And I'm going to try and do 5. But let's get started. I've had a lot of questions in my lifetime as a financial planner about how does a traditional IRA work, and I like to think I'm pretty good at explaining it. But I know that when I explain it just using words and without visual aids, there's a lot of people that get a bit confused. So I'm going to go over it today using this handy clip art version that I worked on over this weekend. None of this artwork is mine, of course. I just downloaded the clip art off the internet. I'm not this talented of an artist, but we're going to go start today. All right. So let's just say, for argument's sake and for math's sake, to make it easy, that you get $5,000 a month in income, and you get paid once a month because I don't want to do this the calculations any differently. But let's just say you make $5,000 a month and you're in the 20% tax bracket. Now, before the income gets passed to the bank over here, Uncle Sam's going to step in the middle and very politely he's going to say, "Hey, buddy, you're in the 20% tax bracket, so I'm going to take my $1,000 before the money hits the bank." And you're like, "Okay, I will accept that because I don't want to go to prison." So the money gets to your bank, you get $4,000 in there. After you pay your bills, because you know exactly what your budget is and you're living below your means, you have $500 a month left over after you put money into your savings account, after you paid all your bills, after you have an emergency fund, and you say, "I want to save for retirement now. I'm going to put $500 a month in my IRA bucket there." Now, once the funds are in your IRA bucket, remember that you cannot take those funds out until you're at least age 59 and a half without paying taxes and a 10% penalty on those. So the money that goes into the bucket is really designed to be used for your retirement. So you can't use it without paying taxes and penalty until age 59 and a half. All right. But now comes the fun part. We're going to start calculating what these $500 a month contributions do to your income and how that benefits you. There's a short-term benefit to this, okay? So we're going to go down to this line right here, and we see that since you made $5,000 a month from your job, you have $60,000 a year in annual income. But you made 12 times $500 contributions to your IRA bucket, so you made $6,000 a year this year in IRA contributions. Now, you get to go to the IRS at the end of the year because you made those IRA contributions and your income was below the exclusion limits and say, "Hey, IRS, let's all pretend that I only made $54,000 a year in income." They let you pretend that instead of having $60,000 a year in income, you only had $54,000. Now you're still in the 20% tax bracket. But now when you do that calculation, you only owe $10,800 in taxes for the entire year, but you already paid $12,000 in taxes, right? So now you get to figure out by taking 12,000, you minus 10,800, you get to figure out how much money you get back in a tax refund. So you're going to get $1,200 on a tax refund. Now you may owe taxes for maybe like another job that you did where you didn't pay taxes or something like that. But let's just say that this is the only income that you have. You don't have any other deductions or anything like that. No kids or anything. This is the only tax refund that you're going to get. Now, if you have other deductions or other tax credits, your tax refund might be higher. But let's just say, for simplicity's sake, this is the tax refund that the IRA causes by putting $6,000 in there if you're in a 20% tax bracket. Tax brackets. Oh yeah. So the 20% tax bracket really doesn't exist anymore. It was part of an older law since 2017 that the tax brackets have changed, and of course the standardized deduction has changed as well. But this is one thing that you'll get a deduction for no matter what, even though you don't qualify to itemize your deductions, right? It's an above the line deduction. So all right, now we're going to move on to the second page of this. How does it work, and how do the investments work inside of there? All right, so now you have this money inside of your IRA, right? You see right here, I'm highlighting this. Inside of the IRA, you're going to buy stocks, mutual funds, ETFs. You might have bonds in there. You might have CDs in there. Particularly, the closer you get to retirement, the more conservative your account might be. You might like the safety of having bank deposits in there, or bonds or something like that. If you're young, or even if you're 10 years away from retirement, I don't recommend being all that conservative. Bond yields have been declining since 1994. Essentially, bond yields have declined from, their normal historical yield of around 6% down to 2% on average. So I don't recommend having those. I think that getting the returns you may have been told that you're going to get over time is going to be a little bit tougher, which is one of the reasons why I'm just using an 8% calculation when we're looking at this example here. Returns might be higher, returns might be lower. I don't know. Anyone who tells you they know is just blowing smoke at you, because nobody can predict the future with any degree of accuracy. I feel like they're going to be lower. This is based on predictions that and projections that professionals have made, but they could all be wrong, because professional forecasters are wrong all the time, right? So we're just using 8% for simplicity's sake, right? So at the end of year one down here, your bucket's still kind of small, right? You put in $6,000 for the year, it grew at 8%. Remember, you put in $500 every month, and that $500 a month grew to the end of the year. We didn't put $6,000 in once and then have it all grow. So at the end of the year, you have $6,224. Now, every year for the next 15 years, you make contributions and you get growth in the account. I'm not saying that you get 8% growth every year. I'm saying that some years you get 15, some years you get negative 10, but it all works out at the end of 15 years where you've averaged 8% over time. Now, you have a good chunk of change in here. You have $168,803, so almost $169,000 after 15 years. Now, that's a good chunk of change, but you really haven't hit the growth stage that you need, meaning what's called the exponential growth curve. So you put in about $90,000 of contributions, and now the account's worth $168,000. So everything above $90,000 is just growth. Now, the nice thing about all that growth is that this is a tax-deferred account. You may have been trading inside of the account. I don't recommend that you do a ton of active trading, but anything you did inside of that bucket is not taxed. Everything is the taxation is deferred on that until you pull it out sometime after age 59 and a half, because we want to avoid the taxes and penalty on there. All right, so now we're going to move on and say after 30 years, you have made contributions still every year and growth every year. You've gotten around an average about 8%. After 30 years, your account is now worth $704,275.29. Now that, my friends, is a good chunk of change, and you can generate a very nice supplemental income with that amount of money. Income to supplement the Social Security that you might be receiving, rental properties that you might own, dividends from stocks that you might own, or loan portfolios, whatever other sorts of income streams that you might have. I do recommend that you have multiple income streams. At some point, some of them are going to fail, and you want to have backups. All right. So we're going to move on now. So how does it work once I start taking withdrawals? All right. So let's say that you're at least over age 59 and a half, but I'd like to say that you start taking withdrawals from your IRA sometime in your 60s. Now the stocks, bonds, mutual funds, ETFs in there, they're worth $700,000. Let's say you've done a really awesome job of creating multiple income streams. Like you've got Social Security, you've got a couple rental properties, and you have an investment portfolio that's an after-tax investment portfolio that pays you a little bit of money every month. So you don't necessarily need to take, a large withdrawal from your IRA. Let's say it's 3.75%, a little bit under that 4% rule, which you should be flexible with that anyway. And that amount is going to be $26,410. Now you deposit that money directly into your bank. The IRS doesn't take any out, or doesn't need to. You can ask them, your IRA custodian, to withhold fundings for the IRS, but they don't have to. You can put it in the bank. But I'll tell you what, the IRS dude, like on the first page, I made him all friendly. This guy's like a thug, man. He's like, dude, you're 59 and a half and above. I want my money, right? And the reason I made him a thug is he becomes a big thug after age 72, right? So you got all this tax deferral in this account. You got to take a tax deduction for the $180,000 over 30 years that you made in contributions. Now, when you start taking money out, Mr. IRS dude wants to be paid. And between age 59 and a half and age 72 now, you don't have to take distributions from your IRA, but at age 72, there's something called required minimum distribution. You are now forced to take contributions from your account. Okay, we're not going to right now. We're just going to calculate the regular kind of thing. So you have $26,410. You're now in a lower tax bracket because you retired, which many people will be in a lower tax bracket and many people will not. You may want to have a certified planner or a certified financial planner like myself take a look at your holistic situation and see if you really will be in a lower tax bracket in retirement, because many people will not, especially now that tax brackets have changed. So let's just say, though, for argument's sake, that you are in a 15% tax bracket. You're going to owe $3,961 in taxes. You pay that to the IRS. The IRS lets you keep $22,449. Now, this is a pretty good way to save for retirement. You put in $6,000 a month while you were working, and now that you're retired, or $6,000 a year when you were working. So yes, sorry, I made a mistake there. You put in $6,000 a year while you were working, and now that you're retired, you get to keep $22,449 a year when you take withdrawals out of there because of the tax deferred growth that you got inside of the account. So it's a pretty good deal. All right. So let's move on to talking just a little bit about some of the rules. Like I said, first of all, you have to, in order to make contributions into your IRA, you have to have earned income. That's rule number one. Rule number two is you can't take withdrawals out of the IRA before age 59 and a half without paying taxes and penalty on the withdrawals that you make. So don't take a withdrawal from that IRA or 401k unless you absolutely have to. There is one exception. You can take a taxable withdrawal with no penalty if you were disabled, or actually a couple of exceptions. And you can take a $10,000 withdrawal to help you with a first-time home purchase. You will pay taxes on that, but you won't pay a penalty on either one of those. There's no way to take the funds out of the account and be untaxed. I've met lots of people who think that there's some way to take out taxes from your IRA and not be taxed. There isn't one unless your income is so low you just aren't in the taxable bracket. Okay. Now, at age 72, the IRS says, hey, we have given you a break all these years. We haven't taxed you on any of the gains in the account, right? So you put in $180,000 into this account over 30 years. Now the account value is worth $704,000. That is well over $500,000 in gains that you've never been taxed on. And let's just say that your income is so high in retirement that you don't even need to take withdrawals off of your IRA. Unfortunately, at age 72 now, it used to be age 70 and a half, the IRS is going to say, hey, we want our money. And that's why Mr. IRS dude kind of looks like shady, like a little gangster, because at this point, this is where you start acting gangster. And he's like, I'm going to take my money. Let's say, when you retired at age 59 and a half, your account was worth $704,000. You took a few withdrawals off there, but you didn't really need it. So now your account has grown to $1 million at age 72. Now, the IRS calculates your required minimum distribution based on a table that they publish on their website every year. And I don't remember the exact number, but let's just say the divisor that they want you to divide your account balance by is 27.3. So we take $1 million and we divide it by 27.3, and the amount of required minimum distribution that you have to take out at age 72 under a huge penalty. So you need to take out $36,630 to satisfy your required minimum distribution for that year. If you don't take those funds out, you will owe an excise tax of 50% on what you should have taken out. So if you didn't take the funds out and then IRS catches you 2 years later and they're like, hey, you need to take these funds out, you're going to pay $18,315 in penalty plus interest on what you should have taken out. So please make sure you take out your required minimum distribution every year. If your bank or custodian fails to take out your IRA distribution at the end of the year, they will not make you whole. Both the banks and the IRS see this as your responsibility. It doesn't matter if your required minimum distribution automatic plan fails. It doesn't matter if your broker or your advisor or your planner didn't take it out for you. It is ultimately your responsibility. That is how all of the custodians and the IRS also sees it. It is your individual legal responsibility. And I know this because I've met a couple of people over the years that asked me or told me that they were going to sue their bank or sue their, their IRA provider, and they all ended up failing because that is the position of of the banks, and that is just something that I find to be horrible. Like if you give someone the responsibility of taking that automatically out of your accounts and they fail, then they should have to make you whole on the tax. But that is just not the way America works at this point. Okay. There's a lot of other considerations to talk about when it comes to IRAs, the timing of withdrawals, how beneficiaries work, what happens now with non-spousal beneficiaries. If you want to know more about that, look at the video that I made on the Secure Act. And I will put the link in the description to the video on the Secure Act, or I'll put that up next on one of the cards or something. But anyhow, that is pretty much it as far as what I wanted to cover today. Once again, I apologize for being sick, but I did want to go ahead and put something out for you guys to see. Um, yeah, so this is Jason, Certified Financial Planner with AdviseEdge, host of the Fighting Words Financial Podcast. If you like this explanation, please like the video and subscribe to the channel for updates on content. Also, I'm going to be having a competition here pretty soon. I'm going to announce what that is in the next couple of weeks. We're going to be giving away something in return for basically a trivia question. Anyway, I will talk to you guys later. Have a nice day. If you like this video, again, please like and subscribe. Thank you so much.